I'll
So,
definitely keep that in my prayers. I'm so sorry.
thank you, thank you. No,
Um, hello, everyone.
good evening,
Can you hear
Professor.
me well? I think I have a
You sound crazy,
microphone
Professor.
issue, audio
Yeah.
issue.
It sounds fuzzy. It
I
sounds a
sound
little
crazy.
fuzzy.
I can hear I can hear static, but I don't think I see. Um, okay, let me fix this problem. Uh, I hear a lot of static from your end. Um, so let me. I hope this can
Sign out and sign back in.
sometimes. Okay. I think I'll have to. I think I'll have to restart my. So to get it back. So just excuse me for a few minutes while the computer reboots. Okay. All right.
All right, Professor.
All right. How do I sound? How do I sound now? Say something.
Way better. Way better.
Okay. I can.
Yeah,
I can.
you sound better.
Okay. Great. You sound also without any static, so it's very clear. All righty. So uh, I have to open all the files again. This is crazy. I'm gonna, where is it? All right. So Now, I just reviewed, our last class, because all our recording, all our collaborate sessions are recorded and updated every day after the class. So in our last class, we spent a lot of time. We spent too much time on the Evergrande crisis. I mean, it fizzled out eventually. It turned out that it didn't. It seems to be, contained, and it's not, spreading, anymore. But then, because of that, we couldn't use the time to really discuss, what had to be discussed. So I think what we need to discuss. So we are pushed back again. We're pushed back. Actually, everyone should understand. Everyone knows. Oh, okay. It says. We're already into topic 2, right? Everyone should understand that we are already into topic 2, right? We're already into topic 2. Financial statements, right? And as of last class, I think you were, these 3 videos were what were assigned in the last class, or four videos. And today, these 2 videos are today's lecture. So keep in mind, the main lecture is already, main lecture is already posted, and we go by. You must be caught up all the way. You must be caught up all the way to this point. Okay, and what's going on in the collaborate is only a reflection, right? It's only a review. So don't think, we are where we are. I mean, in terms of, what we are not the we're not where we are in the collaborate. We are where the lecture goes by, in the main lecture goes by. So so we are still, back by a couple of weeks, like at least like 2 weeks, pushed back by 2 weeks. So let's. Did we talk about? I don't think we talked about the different types of bonds. So we'll have to. Let me quickly check the last. I can do it simply by doing this. So you should all understand that. You should know that the recording of the last class, all the previous classes are here, previous, collaborate sessions, and so it looks like we were.
They have to pay taxes.
All of this. What? Yeah, before they have collected all the payments up to that point from the originally, like Singapore.
So
well, yeah, I don't know, beyond the news, beyond the news. I mean, if you doubt, and then they bailed out AIG, so it was very inconsistent. Just, bear stearns that can be different from the target rate. Yes. When we say banking, there are two types of banking. One is commercial. Retail banking is it could be I think there's a PCN, right? PCN. And what the commercial banks do is basically take your deposit and, or a car buyer, is done by basically right, Morgan's down, right? Held companies that are the stock market is to take them to
talk about that.
I don't know much about Evergrande, but what I know is probably what. Okay, so a lot of last session, the majority of the last session was dominated by the discussion about the Evergrande. So right before that, we were just about here. We were here where we were talking about the role of the Federal Reserve, right? And it is the Federal Reserve, the role of discussion of the role of the Federal Reserve was, crucial because the Federal Reserve is the ultimate authority that implements the monetary policy, and that's where the Fed funds rate also falls into. Okay, so basically, Federal Reserve changes Fed funds rate. First, by setting the target rate, but the actual market rate, cannot be determined by. It's not something that Federal Reserve can say. Let the actual market rate be 3% from tomorrow. No, it cannot be that way because it has to be worked through the market system. So how do they do it? And by walking through the market system, they try to bring the effective Fed funds rate close to the target rate. So how do they do that? They mainly do it through open market operation. And actually, open market operation is the most preferred tool because Federal Reserve has three tools of monetary policy. They can implement monetary policy through open market operation, or changing discount rate, or changing reserve ratio. So, but the primary tool is the open market operation. And the open market operation, first of all, refers to the bond market, right? And we understand what semantics is very simple. Open market means it's open to anybody. Open to anybody. But that anybody means any investor, and investors are either institutional or individual. Institutional investors takes a greater, in terms of the funds they manage, right? In terms of the size of the capital that they manage in the financial market, institutional investors are clearly way much bigger than the size of the capital of the individual investors. So basically, it's open to individual investors and institutional investors. That means anybody, because you can become an investor. You can buy bonds, and you can buy stocks. You can buy bonds. And then domestic and foreign. It can be domestic investors or foreign investors. The bond market is open to anybody. And So Federal Reserve goes into the bond market, sells the bond or buys the bond, right? Buys back the bond that they originally sold. And through this is called open market operation. And so we need to understand first what bond is. So bond is a debt instrument. A bond is a debt instrument with standardized features, so it can be traded. So think about it. When you borrow money, you can only go to the bank, right? Suppose you're borrowing $1 million. You'll have to go to the bank. And it's not easy to borrow $1 million without putting up a collateral, no matter how good your credit score is. If you don't have collateral, if you cannot put up a collateral, it's going to be difficult to borrow. Businesses, on the other hand, businesses have three different sources of borrowing. First, they can go to sources of business credits are manifold. First, they can go to the institutional lenders, such as bank, right? Such as banks, but also they can borrow from the bond market by selling bonds. So, for example, if they want to borrow $10 million, and they can go to the bank, but again, bank will require, most of the times the bank will require collateral. So the company will have to put up their plant, their factory, or production equipment as collateral. But if they go to the bond market, they don't have to do that. In the bond market, they just simply sell bonds for $10 million. And if you borrow from a bank, it will be just a single lender. I mean, if you go to the bank, you borrow from a single lender. Borrow from the bank. I mean, you get $1 million from that bank. Companies can borrow from a couple of different banks. I mean, three banks can form a consortium. Three banks can form a consortium and lend, let's say like $1 billion to the business. That's called a private placement, right? But again, generally, or they can borrow from another, in a private placement, they can borrow from insurance company or asset management firm, or all kinds of, privately arranged, loan contract can be there. But if they borrow from a bank, it's usually, you borrow from $10 million from a single bank. But if you go to the bond market, you can sell bonds to thousands of investors. So if you want to borrow $10 million, you just sell bonds for $10 million. And how does that work? First of all, bonds it's a standardized debt instrument, meaning all the bonds have $1,000 as the face value. Okay, face value is $1,000. That's standardized. Okay, and the face value is not the selling price of the bond. Face value is actual selling price of the bond can be above or below the face value. And hence the face value is also face value is what you get at maturity. Okay, so if a company is selling a 10-year bond, that means maturity is 10 years. At time zero, if you buy it at time zero, the face value is 1,000, because let's say you're buying just one bond. That means 10 years later you'll receive $1,000. Okay. And in the meantime, during those 10 years, you'll just receive interest. And the interest of the bond, interest that the bond pays, is called coupon. And so the interest rate, coupon interest rate, right? The interest rate is called that the bond pays is called coupon rate, coupon interest rate. And if the coupon rate is 10%, what does that mean? This bond pays 10% of the face value, every year. Okay, so if this is a 10-year bond, it pays 10% interest every year, so $100 interest every year for the next 10 years. Okay, so the face value, the name goes by different other names. It goes by different other names. Face value, maturity value, because that's the value you redeem at maturity, right? Value you redeem at maturity, and then it's also called par value, and it's also redemption value, because that's what you redeem. I mean, you redeem 1,000, they redeem the bond, the company redeems the bond by paying you 1,000, right? So face value, maturity value, par value, redemption value. You must be familiarized. You must get yourself familiarized with different other names, but they all mean the same thing. Okay, $1,000. And so, if a company borrows 10 million, they will simply need to sell roughly about 10,000 bonds, right? Why rough? Isn't it exact? Because 1,000 times 10,000 is 10 million. 1,000 times 1,000 is 1 million, right? That's why there are 3 zeros and comma, another 3 zeros and comma. That's 1 million. With one more zero, 10 million, right? But I said face value is not the price, selling price. Selling price could be above or below the par value. That's why I said, roughly about 10,000 bonds, not exactly 10,000 bonds. So these 10,000 bonds can be held by multiple investors, right? There can be 1,000 investors holding, 10 bonds each, or in all sorts of different proportion, right? But the point is, it is, financed by the public. It's financed by the investors, right? The company borrowing 10 million is financing it from, funding it from the market, right? From the bond market. And another thing is, if you borrow $1 million from a bank, then this bank will, and if the loan is for 10 years, this lender-borrower relationship doesn't change. I mean, if you borrow from Bank A until the maturity, Bank A is your lender. You will pay back, right? You will pay back to Bank A, right? But in the bond market, this relationship doesn't hold. In other words, I could be the original at time zero. I could have bought 100 bonds of this company, right? The company sold 10,000 bonds to raise $10 million, and I bought 100. That's $10,000. I mean, $100,000, because about $100,000, right? Because each bond is, about $1,000. That's about, 100,000. But I can sell some of that, right? I can sell all of it or some of it, or I can still hold it until the maturity. If the maturity is 10 years, I can hold it until maturity, collect all the interest for the 10 years, and recover my principal. I get paid, my principal and the last final interest at time 10, right? At the, end of 10 years. Or during this time period, during this holding period, I can sell. If I sell all, and the second investor who bought it, the next investor who bought it from me, can hold it for a couple of years and also sell whenever the price is right, whenever he thinks the price is right. Okay. So this can go on as many times as possible, right? So that's trading basically. So think about it. When the company issues bonds and sells the bond to the public at time zero, that's called the primary market, right? So and after that, all the tradings all the tradings happen between investors, right? Not between the company and the investor, but between the investors. That's called the secondary market, right? All tradings between the investors, that's called secondary market. So the primary market happens only once, right, in the life of the bond. It's the same thing for stocks as well. Primary market happens just once in the life of the stock. But unlike the bond, stock doesn't have any maturity. Stock will go on forever as long as the company doesn't shut down, right? But after the company uses the stocks, then all the tradings are in secondary market. Now, and if the bond's coupon rate is 10%, I told you if the bond, this is just hypothetical because in reality, 10% coupon rate is extremely, extremely good. So that means they are paying $100 every year at the end of every year, but in reality, bonds pay interest twice a year, right? Every 6 months. So if they pay interest every 6 months, then it's $50, right? Every 6 months. Okay, $50. But just for the simplicity of our thought experiment, we'll just assume that the bonds pay interest annually, just to make it easier to. And bonds can be classified by several criteria. One, who issued? Who is the issuer? Right? And the issuers of the bond can be a federal government or local governments, municipal governments, such as state government or municipal governments, and corporations. Okay. In this diagram, I left the municipal bond out because municipal bond has different face value. But all the bonds, other than municipal bonds, all the bonds have $1,000 face value. So if the federal government is the issuer, it's called the Treasury Securities. Treasury Securities, security means basically stocks and bonds, right? Securities mean, but in case of governments, governments don't sell stock. I mean, governments are not private businesses; they don't sell stocks, but they just borrow money. So securities refer to bonds, but then depending on the maturity, the maturities are either short-term or long-term, and the line between short-term and long-term is 1 year. Any maturity below 1 year is short-term, and any maturity above 1 year is long-term. And for Treasury, short-term Treasury is called a Treasury bill. The name is Treasury bill. And long-term, but the long-term for Treasury, I'll have to break it into long-term and very long-term. Okay, generally it's just long-term, but this is my classification: long-term versus very long-term. It's my classification because for Treasury the names differ. Now, for Treasury, if maturity is between 1 and 10 years, is called a Treasury note. Okay, and if the maturity is between 10 and 30 years, is called Treasury Bond, right? So the bond is a name reserved for a very long-term Treasury security, right? And collectively, I mean, because they have different names depending on the maturity, collectively, it is called Treasury Securities, right? That's what it's called, Treasury Securities. Now, for corporate bonds, short-term corporate bonds are called commercial paper. Right? And then long-term corporate bonds are called bond, literally, right? Bond. And corporate bonds can have maturity up to 30 years, but what this means that's not applicable. But what is not applicable is not that they don't have. It's not that they don't have 30 to 10 to 30-year corporate bonds, but what that means is distinction like long-term, very long-term are not applicable, right? In corporate bonds. In corporate bonds, it's just bond, regardless of whether it is 10 years or 30 years. Okay, so also bonds can be classified as coupon bond and zero coupon bond, depending on whether they pay interest or not. So coupon bonds, clearly, coupon is the name, right? Coupon is the name for interest that the bond pays. So coupon bond pays interest, it's interest bearing, and zero coupon bond doesn't pay any interest. Then you might scratch your head. Why? Why would anybody buy a bond that doesn't even pay any interest? I mean, does it make sense if I buy a bond, $1,000 bond today, which has 10-year maturity, and 10 years later I just get $1,000 back? Does that make any sense? Why would I do that? So obviously, in case of zero coupon bond, there must be something else. Instead of although they are not paying interest, instead of interest, what happens is I won't pay $1,000 today for just to get $1,000 back 10 years from now if it doesn't pay any interest. So the point is, such a bond will pay. Such a bond will sell at deep discount. Such a bond will sell at deep discount. So in other words, the selling price won't be 1,000. It will be way below 1,000, right? As a good example, there is something called U.S. savings bond. And what is U.S. savings bond? It is actually 30-year zero coupon Treasury bond. 30-year zero coupon Treasury bond. Now, you can buy U.S. savings bond from the bank. You go to any bank, ask if you can buy U.S. savings bond, and then they will offer you. And most likely, U.S. savings bond sells for $500. It sells for $500. So then if you think about it, if today you buy it and today is time zero, today is time zero, but what I'm saying is this bond just starts today. So it has 30 years left to maturity. So then 30 years later, you paid 500, 30 years later, you get 1,000. So the holding period return, and the holding period is 30 years. So 30-year holding period return is simply 100%. Isn't it right? It's simply 100%. And then, so everyone follows, right? Everyone is following, right? Any question why it is 100%? Okay, I think that's clearly 100% because capital gains, it's all capital gains, right? Over the 30-year holding period, the capital gained, $500, which is a 100% return, right? Which is 100%. So that's so that is zero coupon sells at discount and you earn capital gains. So that's how it works. Now, also, the bond is classified also as premium bond and discount bond, depending on whether the selling price is above the par value or the selling price is below the par value. Par value is 1,000. So if the selling price of the bond, the bonds can sell above par value, 1,100, 1,050, 1,000, whatever. Or bonds can sell below par value, like 900 or 850, 950, 930. So the bonds that sell below par value are called discount bond because it's discounted. And the opposite is called a premium bond because it sells at premium or for premium. And then you can tell, so zero coupon bond is already a discount bond. Zero coupon is already a discount bond because it doesn't pay any interest. But the opposite isn't true. Okay, not all discount bonds are zero coupon bond, right? Zero coupon bond is clearly a discount bond, but not all discount bonds are zero coupon, right? They can be a coupon paying, interest paying bonds, but simply not, selling at lower price than the par value. And why? Why is it the case? Why does that happen? Well, it's all because of the. It all depends on the coupon rate and the average market rate. Okay, prevailing market rate, prevailing interest rate in the market. So take a look at this symbols. I subscript C is the coupon interest rate. That's what the bond pays, right? I used that symbol before. Here, I subscript C, coupon rate, right? Annual coupon rate. So if the coupon rate is greater than the going rate in the market, average market interest rate, it will become a premium bond. And if the coupon rate is less than the average rate in the market, it will become a discount bond. And think about it. Why? Logically, the logical reasoning behind it is first of so now let's think about it. This bond, let's call it bond A. That's the company A. Company A is selling this bond. So bond A. Bond A is paying 10% coupon rate, and average market interest rate is 5%. So what does that mean? Average interest rate means, if you put your money in the bank, you get 5% on average. Or if you put your money in other bonds, on average, you get 5%. But this bond of company A pays, a 10% coupon rate. So if you had $10,000, where would you put your money in? Mm-hmm. If you had $10,000, where would you put your money in? Will you put your money in the bank, or will you put your money in the bond, in this bond of company A? Where would you put your money? Anyone?
I would say I'm scared to say. I would say the bank.
Why would you put your money in the
not
bank?
the bank, the bond, to gain interest.
Make up your mind. Make up your mind. So is it the bank or is it in the bond?
If I had an extra 10,000, I would put it in a bond.
Yes, that's a rational thinking. Clearly, that's a rational thinking. Of course, why would you? Anybody, knowing that the bond pays 10% interest, but on average the bank pays 5%. Why would anybody put their money in the bank? You would put it in the bond, right? So that was Eva, right?
Yes, it was Eva. Yes.
Eva, okay. Eva, so you get 0.25 point for answering that. And then think about it. It's not only you. Everybody will think the same way. Anybody with rational mind will think the same way. Why would you put your money in the 5% in the bank that pays 5%, whereas there is this bond that pays 10%. So if everyone sees it that way, what's going to be the demand for this bond? What's going to be the demand for this bond? What's it going to be like? Anybody?
It's going to be in high demand.
Yeah, there's going to be a high demand. So Peter, right? Peter. So I'm going to give you 0.25. Yes, of course. The demand will be very high and the demand will be very strong. But the number of bond, in other words, the number of bond issued is the same. The number of the bonds issued is constant. In other words, is constant, is steady. So that means supply of the bond of this company A bond is constant, but the demand is strong. What's going to happen to the price of the bond?
It'll increase because it's in high demand. It'll be traded at a premium.
Yes, there you go. Yeah, Peter, so you got another 0.25 for that. Yes, the price of the bond will have to go up, so it will become a premium bond. It will go up even, and it's exactly the mirror image. The opposite is true for discount bond, right? The coupon rate is below the going rate in the market. So these are the classifications for bond. So now we can move into the open market operation. So again, open market operation is what the Federal Reserve uses most frequently. Okay. Oh. I gotta move this around, but open market operation is what the Federal Reserve uses most, frequently for monetary policy. So let's take a look at the mechanism. The mechanism needs to be. So let's assume a zero coupon U.S. Treasury bond with 30 years to maturity, and I just give you an example of this. A U.S. savings bond is 30-year zero coupon U.S. Treasury. Of course, they will have to sell below its par value. So par value is also called face value. P subscript T means price of the Treasury. Okay, price of Treasury. So selling price of the Treasury is way below face value. Normally, it will at time zero it will sell for $500, and so the difference between the difference between the two, right? The face value and the selling price is called bond discount. I mean, at this point, at time zero, this is called bond discount. But over time, I mean, at time t, in other words, 30 years later, this is what exactly? This is capital gains, isn't it right? Over 30 years, there's a capital gain of $500 because you paid $500, and then at maturity, 30 years later, it's $1,000, right? Right, everyone? So it's capital gains. So how do you calculate the return? The holding period return will be basically capital gains over initial investment, right? So you paid 500, and maturity value is 1,000, and it's you paid 500. So capital gains 500 over 500, that's 100%. So this is return on investment on Treasury. Now that's the return for 30-year holding period, and this return is called risk-free rate. Why risk-free rate? I mean that F stands for free, risk-free. Risk-free means riskless, zero risk. And U.S. Treasury U.S. government bond is zero risk. It's no other bonds, corporate or government, are safer than U.S. Treasury, right? Why? Now think about it. If you sell bond, right? If you're a company and if you sell bond, that means you must have income to pay back, right? You must have income, more, specifically, profit. You will have, if you sold 10-year bonds, then that means basically you will have, over 10 years, you will have generated more than enough profit, more than $10 million, right, to pay back, and also more than enough to pay interest for the 10 years, right? And the company that can do that will be rated high. And for governments, for any governments, right, national or local, right, on national level or local level, what is the source of income for government? What is the government's source of income? Anyone?
Is it taxpayers?
Yes, tax revenue, right? Income for government is tax revenue. And we all understand, think about it. Tax revenue is a certain percentage of the national income. Isn't that right? Isn't that right? I mean, everyone pays, corporations pay taxes, individuals pay taxes, right? And our top tax rate may be different. Our top tax rate will be all different. But basically, if you average all of the tax revenue collected, right, from the economy for 1 year, it must be some percentage of the total income of the economy. And total income of the economy is called GDP, right? So then think about it. The size of the tax revenue depends on the size of the GDP. So obviously, the economy with the largest economy, the economy with the largest GDP will have the largest tax revenue, and the largest tax revenue means the ability, the best ability, highest ability to pay back, right? That's called solvency, right? The ability to pay back is called solvency, and it depends on the GDP. And then, of course, U.S. is the largest economy in the world with, about $21 trillion of GDP. 20.513 trillion was the data as of, GDP data as of 2018. Okay. And as of 2018, as of 2020, U.S. GDP, I'll have to check, but it must have been like 22 billion, 22. And then U.S. and then EU, European Union, because it's an economic bloc. It's an economic bloc, but we'll have to. They have single monetary policy. Single central bank called European Central Bank. Before EU, there was all countries were separate. Within EU, Germany is the largest economy, followed by France, and then UK. UK is not part of the European Union, but then Italy, and China did about, I believe, 15 trillion in 2020. Japan, 5 trillion. Japan's economy isn't growing that much, So if you think about it, then it only makes sense why U.S. Is the U.S. Credit rating of the U.S. government is triple A plus, right? And then it's the safest. I wouldn't say AAA, but just about AAA, um, the highest, credit rating. So it's the safest bond in the world. And if you think about it, when all other governments go bankrupt, U.S. government will be the last one standing because it has the deepest pocket, right? It has the deepest pocket. And then as long as there is one last person standing in the U.S. on the U.S. Soil in the U.S. economy, paying taxes, and one last corporation standing, right, paying taxes. Giant corporations are not paying taxes, so that was the problem. But as long as there is one last person standing and one last business standing paying taxes, U.S. government will still stand. So when these last person and last business goes down, only after that U.S. government will go down. The U.S. government will outlast all other governments, outlast all businesses, outlast all individuals, right? So then who could have a better credit rating? Who could be who could be safer than U.S. government? The U.S. government is the safest safest borrower. So the return on the Treasury is called risk-free return. Risk-free return. Now let's think about what happens to this return, risk-free return, when the price of the Treasury changes. Of course, selling price of the Treasury can change. Currently, I said, U.S. savings bond maybe selling for $500, but depending on the Federal Reserve's decision for monetary policy, it can go up or go down. Now, first of all, let's assume that the price of the Treasury goes down. Why will it go down? I'll get to that part shortly. But first, if price goes down, the risk-free return will go up. Why? Why? This is important. Why? Understanding why is always the most important thing. It's just a straightforward mathematical logic. It's simple and straightforward mathematical logic. First of all, let's say selling price of the Treasury goes down. That means this goes down, and this goes down. That means numerator goes down. But what happens to the denominator? The denominator goes down. Denominator goes down. But what happens to the numerator? When the selling price of the Treasury goes down, a denominator will definitely, this goes down, so denominator goes down. What happens to the numerator? Anybody? This is just a straightforward logic. Is there anyone who can answer that? No one? Oh, come on. This is a disaster. No,
The question, I'm sorry, Professor, I wasn't even next to the computer. I'm dealing with something. What was the question?
Oh, you should be paying attention to the, while you are in class, you should be paying attention.
I know, but this session is recorded, so I always go back and
look. You follow up later.
Yes,
yeah, okay.
My wife has cancer, so I have to deal with this first.
Oh,
so I'm
sorry to you.
I'm asking a question. What was the question you were asking?
The question is when the selling price of the Treasury goes down, right? Selling price of the Treasury goes down. The denominator, of course, because selling price of the Treasury goes down, that means the denominator goes down. What happens to the numerator? What happens to the numerator?
The numerator, I don't want to say it's not going to stay the same. It actually increases.
Yes, you're right, Peter. So yeah, of course, you got another 0.25 for that.
Sorry about that, Professor.
Yeah. Well, look. The reason this goes up is because the face value of the bond is constant. It's always $1,000, right? Its maturity value, par value is 1,000. So this is constant, but this goes down, so the numerator will go up, right? Numerator goes up, denominator goes down. So what happens to the whole fraction? What happens to the whole fraction? Anyone? Anybody?
I'm giving someone else a chance.
No, don't wait for someone else. I mean, it will just, delay. It will just, delay the. If you can answer it, please go ahead. Be my guest.
I'm not afraid to be wrong. So you said what happens to the whole equation when the
Yeah,
value
whole
is up?
fraction. What happens to the whole equation?
I want to say the whole equation. I want to say the whole equation actually changes to where
Mhm.
it's not the present value, well, the initial value
No,
anymore.
no, no. This is not present value. It's the return. So
Oh,
this
it's
is
the
a
return.
fraction. This is a fraction, right? Isn't that right? This is a fraction. What
Yeah.
happens to the fraction?
So
Numerator is
you're saying
numerator goes up.
if the numerator
Yeah.
goes up, the denominator stays the same. You do the
No,
same.
denominator doesn't stay the same.
Oh, you said it
Denominator
changes as
doesn't stay
well.
the same. Denominator goes down. We assume the price of the selling price of the treasury goes down. So
Oh,
denominator goes down, numerator goes up. So what happens to the whole fraction?
we change it to a not a multiplication. It is not division
Fraction.
anymore.
It's a fraction is division basically. This is a division. So what happens?
I don't want to say we divide it again because if I say we just divide it, you said the denominator goes up. So now I'm actually
No, no,
confused.
no. No, 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 no. When did I say denominator goes up? Denominator goes down. Numerator goes up. Denominator goes down. Look, we assumed the selling price of the treasury goes down, right?
So PT price of the
So
trust.
this goes down, this goes down, this goes down. The whole numerator goes up. What happens to the whole fraction?
I just think we got to simplify the fraction.
The fraction is in the simplest form. It cannot be simplified anymore.
Yeah, so then I'm completely lost at that point. If it's in the simplest form, then I got no gunshots left for it.
Well, this is just the logic, fraction. Fraction is basically a division, right? And there can be only two directions. It can only either go up or go down. What else can happen? It can either go up or go down. Anybody has any answer? It's a very simple.
Wait a minute. I'm confused. Are you asking what happens to the value of the fraction, or are you saying
Yes, of course. What
okay, so
happens to the
yeah, so the
fraction?
value it goes up because
It
the
goes up, of course.
yeah,
It goes up.
I'm
It
sorry,
goes
'cause
up.
I was confused by how
Yeah.
you worded it. I was thinking that you were trying to turn the fraction into a multiplication or simplify
No,
it.
no, 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 no. This is the fraction, right? This is the fraction. And when something happens to the, denominator and numerator, the result will be either only, going up or going down, right? My question was, what happens to the whole fraction? What happens to the, and that means, look at this, what happens to the whole fraction? I mean, the result of the fraction is this. This is the value of the fraction. And it will have to go up, right? That's the straightforward logic.
Okay, so the
Okay?
value of the fraction goes up. That's what you were asking. What
Yeah.
happens to the value of the fraction?
Yeah. But isn't that the same thing? What happens to the fraction? What happens? Because the result is one number, right? The result is a one number, but a fraction without even arriving at a single number. I mean, the fraction itself represents that value, right? Anyway, Peter, I'm giving you 0.25 for that answer. And sorry about your wife.
Thank you, Professor.
So you're welcome. Now the thing is then, now we understand why when price goes down, price of the treasury goes down, the risk-free return goes up, return on the treasury goes up. So there we can tell there's an inverse relationship. There's an inverse relationship between the price and return, price of the bond and the bond's return, right? Makes sense? And this inverse relationship holds for any asset, any financial asset. It's the same thing. When price goes down, return goes up, right? Price goes up, return goes down, right? This inverse relationship, you have, it's, indisputably, supported by the simple and straightforward mathematical logic, right? And when risk-free return goes up, all other bonds must pay at least more than, at least the same or more than higher coupon rate than risk-free rate. Why? Because think about it. In the bond market, there is the federal government, the Treasury Department borrowing, corporations borrowing, municipal governments borrowing, right? There are many, numerous corporations selling bonds in the bond market, but the biggest player and the safest borrower, the biggest borrower and the safest borrower is the Treasury Department, U.S. Treasury, isn't it right? The safest borrower, right? Nothing is safer than the U.S. Treasury, and the biggest borrower, because U.S. government can borrow trillions of dollars. They borrow, trillions of dollars. So think about it. When the biggest player and the safest player is paying higher return, right? Higher interest, when the biggest and safest borrower is paying higher return, shouldn't other borrowers pay at least something similar or higher, something better, right? Otherwise, they cannot get any investors, right? Think about it. The safest one is paying higher return, but corporate borrowers, right? Corporate borrowers, they will have to match that, and they will have to pay higher interest because they are riskier. Nobody is safer than U.S. government. They are riskier than U.S. government, right? So overall interest rate in the bond market goes up. Overall interest rate in the bond market goes up. Does that make sense? And then the banks will also have to follow suit. Why? Banks are also borrowing from the public, isn't that right? I mean, banks, the deposit that you put in the bank can also go to the bond market. And if the bond market is paying higher return, then nobody will put their money in the bank. So what do the banks do? They will also have to realign their interest rates, which is borrowing rate, right? The rate at which they borrow, and the rate that they pay you when you make a deposit. They will have to also raise the interest rate. So what does that mean? Throughout the entire economy, the overall interest rate goes up, right? So we know that there is an inverse relationship between the interest rate and the economy. We already talked about this already. If interest rate goes up, it becomes harder to borrow. I mean, there's more burden when you borrow. So money supply goes down, right? Borrowing goes down, money supply goes down. It cools off the economy. It cools off. It reduces the output of the economy. Output is the income unto itself, right? And but then how does Federal Reserve? Then the question is, how does the Federal Reserve lower the price of the bond? Well, simply by selling more Treasury securities. Simply by selling more Treasury securities. Okay, simply by selling more Treasury securities. which means, how do they, then, if they sell more Treasury securities, then that's a, increase in supply, right? Isn't that right? That's the increase in supply. And as the supply of Treasury securities increase, demand is constant. A demand for, it doesn't mean, because there are, demand doesn't, demand for Treasury security doesn't just, suddenly go up just because the supply of Treasury securities, go up suddenly, right? So demand is, relatively steady, but suddenly there's more supply of Treasury. What's going to happen to the price of this Treasury? What's going to happen to the price of the Treasury? Anybody to answer this? The answer is already there. The
It goes down.
Yeah, price will have to go down. When there is a excess supply, the price will have to go down. That's why the price goes down. And then return goes up. Overall interest rate in the market goes up, right? Money supply goes down, right? Economy cools off. So, and then it's exactly the mirror image, right? It's exactly the mirror image. It's exactly the opposite. When Federal Reserve buys back, not just buys back the Treasury held by the public in the market, right? Held by the investors. So there will be commercial banks, there will be financial institutions, asset management firms, there will be individual investors, institutional investors in the market, and they are holding Treasury. And Federal Reserve buys Treasury from them, buys back, right? Because originally it came from the Federal Reserve. I mean, it came originally from the Treasury Department, and it was sold through multiple channels, multiple windows, mostly, through commercial banks. But Federal Reserve buys back the Treasury. Buy means always demand. Buy means demand. So that increases the demand, right? When the demand increases while the supply is steady, what happens to the price? Price goes up. When price goes up, return goes down, right? And so on. So this is how they implement the monetary policy, right? By selling or buying back Treasury securities, right? If they buy back Treasury securities, it lowers the interest rate, so money supply increases. So asset purchase, they call it asset purchase, and it's called expansionary monetary policy, right? Expansionary. They inject money supply into the economy through buying back of Treasury securities. And then, we have been on expansionary policy, monetary policy, ever since 2008. So it is called, quantitative easing. Quantitative easing. There were like 3 quantitative easings so far. The last one, and probably 4th one, but the 3rd one was in September of 2012. And then, so the economy has been on an expansionary path since 2009. I told you the economy bottomed out in like 2010, early 2010, and quantitative easing is an extreme case of expansionary monetary policy, because in ordinary average expansionary monetary policy, what they do is they just buy back Treasury securities. They just buy back Treasury securities. But during the quantitative easing, they not only bought back the Treasury, but also they bought the corporate bonds that the commercial banks were holding. Corporate bonds, right? Of course, not the this will have to be at least above BBB rating. Corporate bonds below BBB rating, there's no reason the Federal Reserve would buy those from the commercial banks. And then think about it. Quantitative easing is also called large-scale asset purchase. Large-scale asset purchase. So they mean the same thing. Quantitative easing, large-scale asset purchase, they mean the same thing. And then think about it. What happens between the commercial bank? So think about it. When you buy something, you have to pay. You have to make the payment, isn't it right? And the so when Federal Reserve buys Treasury from buys back Treasury. Give me a break. Okay, I don't have time for this, so I'll just be brief. I just wanted to show you the mechanism. So if Federal Reserve buys $10 million worth of Treasury bills from a commercial bank, Federal Reserve has the liability to pay $10 million to the commercial bank. But when they pay, the money actual cash doesn't transfer, right? 10 million is just a balance sheet transaction. What that means is Federal Reserve, if Federal Reserve buys back $10 million worth of Treasury bill from a commercial bank, it will simply credit the commercial bank $10 million. In other words, on the balance sheet, on 10 million Treasury bill, $10 million worth of Treasury bill was an asset in the commercial bank, and it transferred to the Federal Reserve. So Federal Reserve's, on the balance sheet of the commercial bank, on the asset side, Treasury bill goes down by 10 million, but then cash goes up by 10 million, right? Because Federal Reserve owes $10 million in reserve to the commercial bank, but no cash actually transfers. What happens is Federal Reserve simply increases their accounts payable on their liability side, accounts payable by 10 million. And then that matches the increase of 10 million in reserve, which is accounts receivable, increase of 10 million in accounts receivable by in the asset side of the commercial bank, right? But then think about it. If you have ever got a loan from a bank, right, without transferring any cash, the loan is made. I mean, has anybody ever got a loan from a bank? Any experience? No?
What did you say, Professor?
Question was, has anybody ever got a loan from a bank in the past? And I believe, someone said yes. Was it Eva who said yes? Someone said yes. Yeah.
I said no. Eva? I applied, but I got denied.
Oh, but someone said yes. Okay. All righty. I'm sorry about that, Eva. But if you ever suppose you got a $10,000 loan from a bank, how do you receive it? How do you receive it?
They send it straight to your bank account, or you can get a cashier's check.
Exactly. It could be either in the two forms, either that you receive a check or it gets directly deposited. But think about it. These days, they generally just direct deposit it, right? Even the check is the same thing, do you see any cash? I mean, the money in the bank is not what you can see. If you put $10,000 in the bank, it goes, except for the required reserve, they all send it to the central headquarters. It's all held in the central headquarters, and they don't hold it, they lend it out. I mean, the decision to make a lending can happen at the local level, the branch level, and the branch would, except for the required reserve, they will all lend it out. And if there is a central, and the numbers, all these figures will be reported to the central headquarters. So, and your money doesn't have your name on it. So the money is always being moved around. So if you get a loan of $10,000, it's nothing but the digital footprint. In other words, they increase. You open your, mobile app, banking app. You see the balance increased by 10,000. But there's no physical transfer of funds. There's no need for physical transfer of fund. But without even any cash, physical cash, this digital balance, right? Digital balance of 10,000 will give you the ability to write a check up to 10,000, right? It enables you to write checks up to 10,000 or withdraw cash up to 10,000 from ATM, right? So in other words, there's no need for actual transfer of cash. What happens is between the Federal Reserve and the commercial bank is exactly like that. Federal Reserve simply increases the credit to the commercial bank by 10 million, and so that means increase of accounts payable on the Federal Reserve side, right? On the Federal Reserve's liabilities on their financial statement, they increase the accounts payable by 10 million. That increases the accounts receivable on the commercial bank side by 10 million, which is in reserve. But their T-bill went down by 10 million. But no change in the total amount, right? But anyway, T-bills cannot be loaned out, but this reserve of 10 million can be loaned out. There was no transfer of cash, but simply by increasing the accounts receivable by 10 million, it enables the bank to create a loan up to 10 million, right? That way, money supply increases throughout the economy. That's how the monetary policy works. Okay. And next question is that how does this affect the Fed funds rate? It's on a small scale. It's the similar thing happens on a small scale, a smaller scale, and we are already out of time, so I'm going to talk about this in the next class. And we are behind because in the last class, the majority, the large, large chunk of the class time was used up, in Evergrande, and which was, I wouldn't say it's a frivolous event, but it died out anyway. It died out. It kind of fizzled off. It's not like they're on the brink of another financial crisis. All righty, so I will see you guys on Thursday. Okay, I will have to.
God bless everybody.
All right, you too. Take care,
care. Have a
everyone.
good day, Professor. Take care,
All
class.
righty, you too. All righty.
Later.
I'm gonna stop. All right, take care now. Stop sharing and.